Okay, well, with the financial systems inquiry, the key determinant of what happened was it's been quite a number of years since the financial systems have actually been looked at. So since the Wallace inquiry of the late 90s, and the main reason is the regional banks have said they need to increase competition, and it's become an unfair playing field for them. And so as a result, they needed to assess that, and also looking at superannuation and a number of other issues in the financial system. Well, at the moment, the key issue that looks like it's coming out of it is levelling the playing field between major banks and regional banks, and also assessing what happens with superannuation going forward and annuities and retirement income. They're the key issues at the moment that have come out of it.
Okay, and can you talk me through some of the findings that are now being debated and looked at in the industry?
Yep, so within the banks in particular, the key finding that's come out of it is that the banks, the major banks that is, are not capitalised enough on a global basis. Now obviously the major banks would refute this, and for a number of years they've told us they're at the top of their peer group on a global basis. The regional banks have said, well, you know, it's uncompetitive because of the mortgage risk weights that they have to hold versus the major banks. They actually have a much harder time to actually make a decent return on the same mortgage, and that they should actually level the playing field there and either increase the risk weights for the major banks or decrease the risk weights for the regional banks. Sure. Well, the key I guess the takeaway from this is that dividends can't actually keep growing at the rate we've seen in the past. So obviously retail investors have liked the banks, they've paid out very high payout ratios, and they've continued to tick up year after year. So the key takeaway from this is that with capital requirements going up, or at least becoming more uncertain, the level of dividends growth that we've seen in the past can't keep going up, or at least the payout ratios have to stabilise where they are, and that's all quite negative from a retail investor's perspective.
We all know how dependent and how much self-managed super funds love receiving their dividends. Are people really going to force the banks to reduce their payouts on that front?
Well, it's really just the regulators tightening up on the banks on how much capital they're holding. So while we've seen in the last couple of years, the banks, the Australian banks in particular, have been paying out more dividends to the retail investors and their shareholder base, every other bank globally is actually being forced to hold more capital and pay out less. So that's been quite divergent trends. So as a result, now going forward, then they do need to hold more capital, and to hold more capital, you can't keep paying out the levels you've continued paying, and you definitely can't increase it from here, especially with the revenue growth also under pressure. Well, as an investor in the sector, we're quite underweight the banks at the moment, and the main reason is we see more headwinds in the future for the banks rather than tailwinds, and we see the pressures rising from here.